Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 24th of September here in 2020. We're back to the scene of the crime yet again. This is a similar video that we did last week with respect to the market holding support at this 3350, 3330 level. And we had the push here and the return to it and the push under. And the push into possibly a rally, but no. The market fell. So I'm looking really back at the same logic. And I want to speak from two perspectives. Number one is the intraday or very, very short-term traders among us. Look back at this level, 3325, 3330 in the S&P futures. This is the hourly chart, and it's the same logic. It is the edge of the cliff. It is the edge of support because it was the 50-day exponential moving average or just a key reference level. We're having the same thing play out, and that's what it looked like then. And I think we're back into a similar logic. So the game plan is the following. This is the weekly expected move. The market held that support at the 3220 level, 3218, and also Don's gravity spot, just at this 3211 level, 3211. So 3300, 3300, that's your critical spot. I'll be very clear. The market breaks that and falls under it. Your next stop, 3100. And that's more of a caution than a rush up right here, right now, and get short the market. If you're playing support, you do have decent short-term odds and short-term probabilities. That is off of the weekly expected move. That is off of a gravity spot, and it is off of our volume profile, value area extreme low. Simply stated, 3211, 3220, 3218, all these things align with one message and one message only. Support is expected to hold, so short-term traders can play up away from this level, and that's just what happened on Monday and Tuesday. And if that doesn't happen, we trigger what we call the alternate thesis, and that alternate thesis pushes us down to the 200-day simple moving average, and that continues the drop zone. And if you think of it like that, if we look into the future and we are at 3100, it's as if this little short-term bounce, it was only good for the intraday traders. And that's a little short-term bounce for that. What we'll do in tonight's video, just to get that, I don't want to call it a warning, but at least a caution sign out in the open there. If this starts to fail, the next stopping zone, like a little train going to the station, we left the station here, we're midway to the other station, and if the train keeps going, the train does not stop and turn back to the upside right here, the next week, you'll see the S&P stopping at the station of 3100. And as we look at that, I do want to take a look at some of the market cap names. And that's going to be where a lot of the clues will come from, whether or not the market holds the bounce support or cracks beneath it and extends the sell swing all the way to that level. Just for reference, I've been showing you this. The last time we were in this situation, the market again was in an uptrend, higher highs, higher lows, rising, moving averages. Looked like that in real time. Looks like this in real time right now. Higher highs, higher lows, rising, moving averages. The thing that changes right here is the volume. The bull volume was going down. The red bear volume or sell volume was going up. And as the market pushed lower, that's where we are now. See the red volume? That suggests further selling. That's what happened, maybe a little faster, in 2020, January, February. No, I'm not predicting COVID's going to resurface. I'm just saying the signs are there for caution. That's the main idea. Caution, protection, defense. And if you're aggressive, you have a lot of short sell plays and the 100-point drop to 3100. If it seemed a little bit impossible for the market to fall from 3300 or 3330 to 3330, here we are, we're there. So intraday traders can play both directions, but swing traders need to be fully aware that markets do go up, markets trend higher. More of the times than not, the stocks go up, feel like they can never go down. But if you're about to buy this dip and you think that everything's going to be okay, all I can do is reference your attention or draw your attention back to when the situation was identical, or at least very similar, and that was into February. Uptrend, higher highs, higher lows, reduction in bull volume, increase in bear volume. And that market fell much, much, much deeper than the 200-day simple moving average. I'm not asking it to do that. I'm not even thinking it's going to do that. But I am prepared for it to fall back to the 200, and that will guide my trading decisions, either as an intraday trader, trading to the downside on the way lower, 100 points down, or a swing trader can stand aside, avoid the drop, or play some puts or play some aggressive positions into it. That's the bigger picture. Now, I'm just going to show you the market cap names, starting with Apple. And the logic will be the same. So I won't draw all your attention to it, but just go back. I would recommend if you're on your own time, taking a look at these names, how they fared in January into February, how they moved from the 20-day exponential, that's typically a buy spot or buy zone, into rising stocks, strong stocks getting stronger. We do a lot of work with that. When that fails, it typically hits the 50, and to the extent that the market trades under the 50-day exponential average, it increases the odds that it falls all the way to the 200-day simple moving average. It's a little price pathway, edge of the cliff, drop zone, make or break level. All those terms play into this. But if you're curious about what happened then, might it happen again? No certainty, certainly not. But as long as it's under here, the caution signs are there. And that's where we'll focus most of tonight's video. Microsoft seems a little bit better back in the old February time. Right? Some little volatility. Didn't go straight down. Fell, retraced, fell, cracked under. Fell, retraced, cracked down. All I'm saying is the risk is high for the market to push down to the 200 simple. And if the S&P is going to get there, this is how it's going to happen with leading names and big market cap stocks, which includes Microsoft. And then Amazon. Now that traded down from 3600. We do have our bearish volume spikes right here, and those were in play similarly back in February. So Amazon spot is a little further down, and what you'll do for pricing or spread trading or risk management is reference this 200-day simple on these charts and maybe the 50 and the 20 exponentials on the daily charts. They are not magic, but they do give you spots to manage risk and define the trends. Google, right, if you think this is impossible, there's no way possible that these stocks, Amazon, can't go there. Google is a leader. Google already is at the 200-day simple moving average. So it is holding support. So playing into these names, Google could be a potential support bounce play, and that's off the 200-day simple moving average. Depends on what you're looking to do with the stock, buying into it or managing risk in the event that Google shares fail to bounce and instead continue falling. Well, again, draw our attention back to February into March. From the 20 to the 50, from the 50 to the 100, or the 200, a little bit of a bounce and down. So that's Google. Facebook is up next. That little level is 220. Berkshire Hathaway is a financial company, so it does not fit the mold of the other names in the large market cap scan. This again is the S&P 100. Can be the same thing with the S&P 500 or different indices, including the Nasdaq. So Berkshire Hathaway is up next. It is holding support at the 50. Visa is a financial company, but it's not that far from the 200 at this point. And we'll stop with Walmart, which is a retail name, and it's doing well. So it's not all bearish. Right? It's not all bearish at all. But the risk is there. Risk and reward. Risk of a drop deep, deep, deep lower. Not all the way to oblivion, but just down to the 200 simple moving average. Keep these stocks in mind, and any other stock you might be trading or looking at. We'll look at Nvidia. Nvidia is a strong stock getting stronger, but it's holding support. So things are different. But all these stocks playing together in the S&P 100 and the S&P 500, That'll make your movements in the S&P. So if they all start to crack and burn and fall in the abyss, that's how the S&P gets there. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video, September 24th, 2020.